Well, let's take that conversation forward. Stephen Irons, managing partner with SPI Asset Management, joins us. And then we, of course, have good old Peter Maguire. Good morning, gentlemen. Peter, how you been, my friend?
Very well, thank you, Nakunj. Good to see you. Happy Monday.
Well, so far it's turning out to be a good patch for equities, commodities, and for global bond markets, Peter. Will this Goldilocks scenario continue?
Well, I think in a lot of ways, and greetings from Sydney, I think a lot of ways, yes, and I'll say why, and I'll preface that with OPEC Plus over the weekend. That was quite extraordinary to up their production output from 411 to 528. 548, I should say, and I think that that's going to really create that glut that everyone's concerned or conscious of going into the August timeframe and then leading into naturally Q4. So very good time for consumers, not that great for producers, and I think it's a race to the bottom as far as price, Nakunj.
Right. Stephen, hi, morning. Pretty much seems like the penultimate patch and the grand finale now to tariffs. While there is chatter that the deadline itself may be extended to August 1st, but it seems like in the next 2 days a lot could happen.
Yeah, looking at the way the markets are trading or have been trading over the past fortnight or so, seems to me that most desks are leading into a derivative of the taco trade. That's the Trump always chickens out. It's a well-worn reflex in the markets right now. Although, sure, there's still some chatter that the tariffs could come in a little bit higher. But I think what we're seeing right now is the acceptance that we're going to fit into some easier base tariff, something around 10 to 14%. Effective tariffs rate in the U.S., which is by all accounts quite manageable. Of course, we're still trying to figure out how that passes through into two key areas for equities. One is inflation and how that will have implications over the Fed Reserve policy. I think a lower tariff sort of alludes to a VAT style structured tax, which won't be a tactical resurgence of inflation. It'll be a one-off inflation. And then we're looking at how it impacts margins on who's going to be absorbing the bulk of these tariffs. Traditionally, we'd expect corporates to pass through a bulk of these tariffs. However, we're not seeing that play out into inflation yet so far on the tariffs that are currently structured. So it seems to me that either corporates are eating some of this or the exporters are eating some of it. So we're not quite sure how this will impact into Fed policy. We may very well have a very dovish Fed policy come the end of summer, and that will continue the rally forward. But again, all predicated on the absolute levels of tariffs across the board.
Peter, when we spoke last time, you said buy a lot of gold. Is it still buy a lot of gold?
I think so, Nakunj. I think absolutely 33.20, 33.40. Yeah, I think it's very affordable. I think from a couple of points moving forward, and I'm saying that's going to be a long-term hold. See the decade out. The momentum at the moment, it's had an incredible uplift, as we all know, over the last 18 months or so, or approaching 2 years. And I think that general feel from central bank buying to what's going on with currencies, US dollar the way it is, and certainly from an interest rate perspective, I think the overall momentum is going to be continued. Retail are all over it, and the man and woman on the street are certainly enjoying it, not just in India, but around, certainly Asia, and the appetite isn't waning. So yes, I think its best days are ahead of it, and I will continue to, be bullish on the call.
Okay, Stephen, if you have to identify one asset class which has scope to outperform in the second half of this year, will it be equities? Will it be Bitcoin? Will it be gold or something else, Stephen?
I like gold. I'm a more traditional gold buyer. I think I've got some Asian influence after spending 2 decades here. I think the setup looks quite comfortable going forward. Central banks are definitely in buying for the de-dollarization and the reserve structure. They're very much under-owned as far as Asian central banks are concerned. They're starting to catch up with the Western central banks, and there's a long way to go for that catch-up play. I also think beyond the de-dollarization, what we're seeing right now is this little bit of an east-west confluence right now. We've got a lot of retail traders in the U.S. selling their golden eagles right now because they don't think the tariffs are going to be all that aggressive. So that one element of risk is coming off the market. But when we look over in Asia, the Asia buying is still very momentous, especially in China and India. And this is going to probably hold up the physical markets, even with North America retail sellers. So it's going to be an interesting battle going back and forth. But ultimately, I think gold picks up the baton and runs quite a bit higher over the next year or two.
Right. Okay. Peter, great to have you on the show today. Thanks for taking the time out and joining in. And good to have you, Stephen, as well on the show. Let's talk about